What if China's next big move could shake the US housing market so deeply that home values teeter, mortgage rates spike overnight, and the dream of secure retirement slips right through our fingers? Imagine needing to refinance or downsize only to discover that the market is suddenly flooded with uncertainty. No one wants to face a situation where their home is harder to sell or where monthly mortgage costs jump just as you settle into your golden years. We're not here for long-winded intros today. The stakes are far too urgent, especially for anyone living on a fixed income or relying on stable home equity for financial peace. We'll get straight to the heart of the matter because it's critical to understand why mortgage rates are rising and how the escalating international tensions tied to U.S. Treasuries and specifically to mortgage-backed securities could become the final straw for countless homeowners and retirees. Once we see the hidden links between global politics, bond sales, and your daily financial security, it becomes clear that ignoring this threat is not an option. Lately, mortgage rates have climbed sharply. While its true rates roughly follow the 10-year Treasury yield, we also see a wave of speculation that foreign governments could be selling off U.S. Treasuries in retaliation for aggressive trade policies. One particularly large concern stems from China, one of the biggest holders of agency mortgage-backed securities, MBS. If China decides to accelerate its reduction of these holdings, or if other major nations follow suit, we could see a jolt that goes well beyond normal market fluctuations. Why should this matter? Because if foreign governments dump American mortgage bonds, the immediate effect could be an even steeper rise in rates. At a time when spring housing markets are historically important for buyers and sellers alike, any dramatic shift can wreak havoc on real estate values. It's no secret that homeownership remains a cornerstone of financial stability for many older Americans. The worst nightmare scenario would be watching your hard-earned equity evaporate if demand drops and new buyers balk at exorbitant interest costs. That's why it's so critical to ask these tough questions now and be prepared for what could happen next. The real threat here isn't just a short-term uptick in interest rates, it's a sustained disruption that could choke off affordability, strain household budgets, and potentially stall the entire housing sector. What happens if mortgage rates begin a relentless climb and never truly settle back down to those comfortable lows we saw in recent years? For a new generation of homebuyers already grappling with inflated prices, it might mean giving up on the idea of buying altogether. For retirees, especially those in their 60s and older, higher rates can drain resources. After all, even if you plan on downsizing, you might find fewer qualified buyers in the market. And the offers you do get could be substantially less than you hoped for. The consequence of inaction, of just letting this possibility fly under the radar, is profound. If foreign countries, especially big players like China, decide to leverage their immense portfolios of MBS as a bargaining chip, the ripple effects could touch everything from your monthly mortgage payments to the broader economic climate. Picture a chain reaction. Higher mortgage rates discourage borrowing, fewer sales occur, home prices soften, and property tax revenue could drop. This doesn't just affect those carrying a mortgage, it undermines municipal budgets, local services, and community investments. Seniors hoping to tap into their equity for medical expenses or to assist family members might find themselves squeezed. Picture having that nest egg meticulously planned, only to see the home's value slip away at the exact moment you need it most. If we shrug off these warnings, we risk being blindsided by a wave of challenges that can snowball rapidly, leaving little time to adapt. To grasp how severe this problem might become, consider the huge chunk of agency mortgage-backed securities held by countries such as China, Japan, Taiwan, and Canada. While domestic investors and the Federal Reserve also hold large amounts, the power these nations have to liquidate, especially as a retaliatory measure, is real. Not long ago, China already started reducing its MBS holdings, shedding them at a noticeable pace. Japan also showed signs of cutting back. If this is just the beginning and these actions intensify, the result could be a swift and unsettling jump in mortgage spreads. When those spreads widen, interest rates climb for everyday Americans, not just for the top-tier property owners. How might that impact a typical homeowner? A bigger monthly payment and a home that's harder to refinance or sell. For someone close to retirement, that's a triple whammy. Less disposable income, more difficulty finding a buyer at the right price, and a riskier environment overall. Consider how this ties in with broader economic concerns. When mortgage costs climb, consumer confidence can dip, and we've already seen how a faltering stock market can lead buyers to back away from new home loans, especially if they rely on selling stock for their down payment. Fear and uncertainty feed each other, and that cycle can push potential buyers onto the sidelines. A once booming housing market can cool down so fast that sellers are left scrambling to adjust expectations, often at the worst possible time. This isn't meant to be doomsday talk. However, ignoring how interconnected our housing sector is with global finance puts every homeowner or potential homeowner in a precarious position. Think about how drastically the Federal Reserve's policies shifted during the pandemic when it began buying MBS to prop up rates and keep the economy afloat. Now that the Fed is letting MBS roll off its balance sheet, there's a vacuum, and if foreign players decide to dump even more, it compounds the pressure. Suddenly, what was once a pretty stable mortgage rate can spike unpredictably, leaving folks on fixed incomes or careful monthly budgets scrambling to afford living costs. So how do we begin to shield ourselves from such uncertainty? The first part of the solution is awareness, which might sound almost too straightforward. But if you've never considered how global finance intersects with your home loan, now is the time to connect those dots. Being aware also means staying on top of local property market indicators. Watch how many homes are going up for sale, track if prices are leveling off or declining, and pay attention to local news about property tax discussions. If you're in the market to buy, perhaps weigh the pros and cons of locking in a rate sooner rather than waiting for the perfect moment. Sometimes waiting can backfire if foreign sell-offs push rates higher. But there's more. Those who already own homes might want to review their refinancing options, even if it's just to confirm whether they're in the best position possible if turbulence strikes. For those eyeing retirement, it might be time to have honest conversations with financial planners about how a potential squeeze in home prices could affect your future. That might mean looking into alternative savings strategies or diversifying assets so you're not overly dependent on real estate equity. The core takeaway: small steps now can help you adapt if foreign bond dumping becomes a harsh reality. Yet, this only scratches the surface of what savvy homeowners or soon-to-be retirees can do. There are still many complex variables at play, and we haven't even touched on some surprising moves by other countries that could escalate tensions further. Before we dig deeper, let's do something important for our community. I want to hear your insights, experiences, and even your worries. Dear viewers, have you noticed any shifts in mortgage availability or rates in your region? Have you tried to refinance or sell your property recently? Please share your stories in the comments below, because by discussing these matters, we help each other stay informed and prepared. Your contributions might alert someone else to a brewing change they haven't yet noticed. When you take a moment to comment, you're not just checking a box, you're taking part in a collective effort to protect our financial well-being. Now that you've taken that moment to engage, let's revisit the importance of vigilance in these uncertain times. Even with partial solutions like refinancing early or diversifying investments, we can't overlook the underlying cause. International friction, particularly surrounding tariffs and trade disputes, has the power to roil not just the stock market but also the housing sector. If China or other nations decide to escalate, it could happen quickly. We've already seen how swiftly Treasury yields can move when big players start selling. Mortgage bonds are a similar story. Higher selling pressure means yields and mortgage rates can leap upward. What was once an affordable home loan might suddenly feel like a burden you can't easily carry. It's essential to see the scale here. Foreign entities hold over $1 trillion worth of U.S. mortgage-backed securities, and that figure used to be even higher. Any coordinated sell-off would send shockwaves across multiple sectors, including the construction industry, consumer spending, and local government revenue. As 65-plus homeowners, retirees, or near-retirees, you're often more financially exposed than younger people because you may rely on steady home equity or a fixed income. Declining property values can limit the options for aging in place or moving to a more convenient, possibly assisted, community. That's why we have to keep this conversation going. Even if you think your retirement plan is robust, a downturn in the housing market can erode that sense of stability. What if we do nothing? If we turn a blind eye, we risk being caught off guard. Imagine 3 or 5 years down the road, realizing you're stuck with an outdated mortgage at a rate that's no longer competitive, or holding onto a home that isn't appreciating the way you counted on. In more dire cases, a reversal in property values can upend estate planning and lead to unforeseen financial burdens on family members. The future doesn't have to be grim, but it won't brighten on its own. By reevaluating our choices and staying informed, we position ourselves to adapt if events escalate and mortgage rates climb beyond what we're prepared to handle. So let's talk about a more complete set of solutions. First and foremost, diversify. If you've been heavily reliant on your home equity for your long-term security, consider balancing that with other forms of investment: annuities, dividend stocks, bonds, or even small business ventures that generate steady cash flow. The housing market might be the centerpiece of American wealth for many, but it's far from the only game in town. This approach can protect you if property values hiccup or mortgage rates surge, ensuring you still have fallback options. Second, keep lines of communication open with financial advisors who monitor the macro environment. They can spot red flags early, like unusual trading patterns in treasury bonds or a significant spike in mortgage-backed securities yield spreads, and guide you on whether to lock in a rate, adjust a portfolio, or stay the course. There's also merit in planning for different timelines. If you are hoping to move or refinance in the next year, weigh the pros and cons of acting sooner. Doing so can help you catch a window of stable rates before any international disagreements blow up. For existing homeowners with decent equity, looking at home equity lines of credit, HELOCs, to consolidate any higher interest debt might make sense. Just be cautious about not over-leveraging your property. The Federal Reserve's stance on shrinking its own MBS holdings isn't reversing anytime soon, which means the safety net that propped up housing finance in emergencies is no longer there. We're essentially more exposed now to foreign policy moves than we have been in years. Finally, try to stay grounded. Yes, the possibility of a major disruption is real. Yes, China or other nations could use MBS as a bargaining chip, but rates and markets do move in cycles, and being proactive is far more effective than being paralyzed by fear. If you're armed with practical steps, diversification, refinancing at the right moment, and keeping watch on global indicators, then you can reduce your vulnerability significantly. It's not about panicking, it's about being prepared. In light of these strategies, we should also remember that the housing market reflects more than just cold numbers. Real estate is deeply personal, shaped by emotions, aspirations, and the simple desire for a stable home. For older Americans, especially those living off retirement funds or Social Security, the interplay between health, location, and finances grows more intricate each year. Housing isn't just an investment, it's also about accessibility, community, and comfort in your golden years. That's why any shakeup in mortgage rates triggered by foreign sell-offs can be doubly stressful. It hits both your wallet and your sense of security. And while diversification is a cornerstone of the solution, we should also pay attention to how government policy might shift. In a crisis, we've seen the Federal Reserve step in to stabilize markets, but with inflation concerns running high, the Fed's intervention might be less aggressive than in past downturns. If China's moves escalate tensions, there's no guarantee that Washington will swiftly calm the storm. Political brinksmanship often complicates rational economic decisions. So, in many ways, we're left to fend for ourselves with savvy planning, robust financial literacy, and a network of reliable sources of information. If there's one thing to remember, it's that the window of opportunity to adapt is open now. The worst-case scenario may never fully materialize, but partial sell-offs or incremental policy changes can still chip away at the market stability. If that happens, the effect on housing could be gradual yet persistent. Rates creep up, home sales dip, and homeowners slowly find themselves in tighter and tighter corners. That's precisely why maintaining a flexible plan is so vital. If you're thinking of selling soon, perhaps expedite that plan. If you're buying, shop carefully. Look for neighborhoods that hold value in downturns, areas with consistent demand, strong local employment, and a history of stable prices. With the right approach, you can navigate these challenges without letting the fear of a foreign-led sell-off paralyze your decisions. All this leads us to a simple but powerful closing thought: staying informed and taking early action can make a tremendous difference. Don't wait for the headlines to scream crisis. Start exploring your options, discussing scenarios with professionals, and maintaining a watchful eye on global signals that could foreshadow turbulence. Keep an ear out for changes in treasury yields, MBS pricing, and any policy announcements from major holders like China or Japan. Because in the end, your home is more than a roof over your head, it's a pillar of your financial future and, quite possibly, your legacy for the next generation. On that note, we'll bring this discussion to a close. By now, you've grasped why China dumping mortgage-backed securities is not just a matter of political tit-for-tat, it's a situation that could directly affect your everyday life, your retirement plans, and your peace of mind. If you found value here, consider subscribing and sharing this video. It's not about boosting numbers, it's about creating a community of informed, proactive individuals who can adapt and thrive despite international headwinds. And if you haven't yet shared your experience or your questions in the comments, please do so. You never know who might benefit from your perspective. Stay mindful, stay prepared, and stay hopeful. Thank you for watching, and until next time, take care of yourselves and your financial health.